Welcome to the Dairy News and Views podcast, a production of the Iowa State University Extension and Outreach Dairy Team. Our podcast covers current educational, research, and industry tools available for your operation to manage healthy cows and calves while producing the highest quality dairy products.
Absolutely. Thanks for the opportunity. Good morning, everyone. As she said, I'm Matt, and I do come from Southwest Wisconsin. Been in the business for about 11 and a half years now. If you ask yourself, how do you get into being a commodity broker? My boss and I have started to kind of joke about it a little bit in front of crowds. I tried to do an internship with him my junior year of college, and he turned me down for another kid. I tried to do an internship with him my senior year after I had graduated, and he turned me down again, forcing me to do an internship elsewhere. But after I did my internship, I came back to him. I said, I don't need an internship, I need a job. So I guess it just takes a little bit of persistence to get into these markets, but I've been enjoying my time ever since. Primarily working with dairy farmers, but I do work with some beef clients and grain clients as well. But given my background, I always sort of went towards the dairy end of the spectrum, and I don't necessarily help my family out wherever needed. I haven't milked a cow in about 10 to 15 years, but whenever there's a tractor driving job, I'm all for it. So that's kind of what my experience on the dairy is these days. So we're going to start out with milk production. Milk production has been a topic that's kind of had a bunch of different expectations for 2025. We've heard all along a shortage of heifer numbers was likely going to weigh on milk production and our prospects for additional milk production. In the most recent milk production report, it was the month of April, and ultimately we put forth a growth percentage of 1.5%. And as we move forward, we are expecting actually to move up towards 2% year-over-year growth. We'll get the next edition, which is the May report, come next week. And while 2% looks like a really big number, and it is a solid number, remember last year, 2024 numbers were down. And so we're going against much easier to beat comparables. And what was the story last year? Well, it was the bird flu. Okay, we started seeing the bird flu pop up in May and June. Nobody really knew what it was quite at that moment in time. We had a number of veterinarians across the country trying to dive in and trying to determine what was affecting these cows. It really started in Texas, but it also hit Idaho, it hit Colorado, it hit Michigan, and it also later hit California, kind of in that September and October timeframe. And so we are likely going to see bigger than normal advances in milk production as a result of bird flu that hit 2024. Now, when we look at where the growth is, Kansas is going to be a leader. Right now we have Hillmar cheese being built in Dodge City, Kansas. Right now we're looking at that plant being about 2/3 of the way full, but the dairy farms are still being built. Right now they're supplying that plant from milk from other regions. So Kansas is going to be a leader. You're going to see Texas as one of the big leaders as well, with the Leprino plant being built in Lubbock, Texas. You're also going to see South Dakota continue to be a leader as Valley Queen continues to grow. So in the most recent milk production report, we were just north of 9.4 million head of milking cows. That was a 5% month-over-month change, and we're up 89% year-over-year. At some point, we do expect to see U.S. milk production, U.S. cheese capacity start to weigh on milk prices, not just here domestically, but also internationally as well. So we'll look to see what the May report has for us here next week. And it's not just milk production that is increasing, it's also components. Just look at the last 5 years. We were closer to about 4% than 4.05, 4.1, 4.15, 4.24 last year on a butterfat percentage. And that's the average across the country. That's not just the upper Midwest. Okay, so even in the states such as Texas or California where it's hot and you have open lots, they're also seeing advancements in their components. This has and is a result of milk plants asking dairy farmers to ship more components and less fluid. The funny thing and the ironic thing is that there's a couple of plants out there right now asking dairy farmers to ship less components in the milk. And so that's kind of humorous to me. But when we look at March, butterfat ran at 4.36%. Again, that's the national average, up from 4.27 a year ago. When we look forward, we expect the milk solids to increase by about 2.3%, and that is the equivalent of adding 215,000 cows just by the advancement of components in the dairy milk. In the past, the goal has always been to get to a combined component level of butterfat and protein of 8%. That's what dairy farmers have been trying to achieve. I was with a couple of dairy farmers last week, and they're over 8%. In 5 years, they want to get to a 9% combined component level between butterfat and protein. And so the genetics of dairy cattle are certainly improving significantly as we go further and further. And a lot of these dairies are getting these components now on Holstein cows, not just Jerseys. So when we look at the additional butterfat that we saw, that is an extra 275 truckloads of cream per week that we saw in Q1 2025. That's the equivalent of 27 million additional pounds of butter production throughout the country. So big numbers. Now you might ask yourself, in a situation where heifers are very tough to come by, we're hearing 4,000, 4,100 for a springing heifer these days, and if you look at the USDA inventory levels, they would suggest that inventories of heifers are down. But you might ask yourself, how are we increasing animals on the milk production report by such a solid rate? Well, the answer is this: light slaughter. When you look at the yellow bars, that's 2024, 2025. The orange dotted line is the 5-year average, and the blue line is the 5-year max. We're nowhere close to year prior levels as far as slaughter is concerned. We're 8% behind right now, which equates to 88,528 head. On one of the previous slides, I showed that the milk production report, we were up 89,000 year over year. This is where it's coming from. And the reason behind it is the beef on dairy economics, right? So we're hearing that day-old calves are ranging anywhere from $1,200 to $1,600 per head. With that same dairy that I was with last week, I should say, he's saying that he's getting $1,300 a head regardless if it's a black beef on dairy cross, whether it's a Holstein bull calf. Everything that he's getting is $1,300. We heard last week that some calves in Minnesota went for $1,550, and we even heard in the Milwaukee market a $1,600 head, and this was my favorite. A farmer that I work with, I was recently with him, and he told me that he had triplets, and all of them had a black coat on them, and he got $1,200 for each and every single one of those calves. $3,600 on one birth. That cow has earned herself another lactation and likely another pregnancy. So slaughter is way down. I think this is going to be one of the most important stories that we follow this year is the European Union. The European Union, all of their countries are essentially in some sort of a drought. And it is starting to affect feed quality and feed availability. Europe already has some issues ahead of it in regards to regulations and whatnot. They are decreasing their milking herd as a result. But look at Germany and France. These are two of the top 3 milk-producing countries in Europe. Only 2 weeks so far this year, through May 17th, have they shown positive growth compared to last year. And they were down as much as 3%. They did receive some rain last week, and so that has bought them a little bit of time before it gets into more of a dire situation. But when it comes down to it, the situation is very dicey, and it's very unlikely that they're going to produce more milk this year, which is going to, and has already elevated some of their product prices, and it's also given us an opportunity to get into those spaces for exports. So this is probably one of the number one factors that I am watching this year, because if Europe can stay steady, even if we have excess cheese or more than we can consume here domestically, the export market could be the story to decent prices in the United States. Now this is a really fun chart. This is all of the plant expansions across the United States between the years of 2024 and 2029. These are all the announcements. Some of these have been built, and I want to focus in on a couple of territories. Number one, I want to focus in on New York. New York is seeing tremendous expansion. New York State offered both producers and processors a 20 or 25% tax credit to come to New York to build your dairies, to build your processing, bring jobs, so on and so forth. And New York responded. So we saw Great Lakes cheese get built in 2024. Fairlife is coming to New York in 2025. They haven't broke ground yet, but they're still coming. Cayuga is out there. Chobani just announced a massive plant in Rome, New York, and a few other ones. By our estimations, New York needs to increase their milk supply and their dairy herd by 50% in order to fill that capacity. Now, don't ask me where all of the feed's going to come from or how close to the dairy the feed is going to be, because it does look like we're going to be trucking it a ways, but tremendous growth there. Texas is another state that's seen significant increases in processing, primarily to service the Mexico market, but also kind of the southern tier. Walmart is starting to take things into their own hands from a fluid perspective. They have one in Georgia, one in Texas, and they have one in, I believe it's Ohio or Indiana. I think it's Indiana, actually. So they're seeing quite a bit of progress there. But when we take it into just cheese specific, since this is where most of the concern was for the 2025 market, we have a ton of different plants. So last year, we saw Panhandle Products. That's going to be a 6 million a pound day facility off of Jersey milk. So when you translate that and reflect it upon higher components, it's going to kick out the equivalent of 8 million pounds of milk per day. Hillmar is another 8 million a pound intake day. Leprino Foods is going to be a 10 million pound intake a day. Valley Queen doubled. We're seeing some expansion here in Wisconsin between Grande Cheese and two facilities that Cheese Merchants runs. And so we are asking ourselves, where is all this cheese going to go? At least for the next couple of years, I think it's going to be very dependent on the export market to really balance the market. So we'll have to stay in tune with that. Now, when we look at the cheese price at present, we look at this as more of an opportunity. The blue line is going to be the United States, the green line is New Zealand, and the orange line is Europe. When we look at New Zealand, we are cognizant of their price, but we don't give a ton of weight to it. The reason for that is most of their product goes into China, and the United States does not compete in the cheese world with China. We compete with them on weight and powder, but not cheese. And so we're really looking at Europe and the United States, and what can we tell on a cheddar basis? Europe is trading at about $2.35, $2.40. The United States is closer to $1.78. This chart is about 2 days out of date, and we did not perform too well in the block cheese price the last couple of days. But regardless, we should find some cheese buying. We should find some export orders with the price as is compared to Europe. And as we just kind of talked about in Europe, with the drought that they are seeing, it is not very likely that their price is coming down all that soon. Now, spot cheese has had a very difficult time moving above $1.95 to $2. And we kind of feel like that's the ceiling where we would start to lose out on the cheese export front. This chart is CME spot blocks and CME spot barrels. Now, with the recent federal milk marketing order changes, the green line, the barrel, that doesn't really matter anymore. We're still going to produce barrels for the fast food restaurants, but when it comes to pricing from a Class 3 perspective, starting with the June contract, that is no longer relevant. So early in the year, we basically took prices up to about $1.95, but when we started talking tariffs, cheese markets really started to go in the tank. We've been able to build it back up because when we did go to 160, 165, we were 80 cents discount to Europe. And so we booked a ton of exports, and you'll see that in the coming slide. But this most recent run, we also took it right back up to 195, and we failed again. Part of the reason why we went up to 195, in our opinion, is because Hilmar and Leprino are behind schedule. And there were also some quality concerns coming out of the Hilmar plant in Dodge City. Excess moisture in the cheese and also some issues with their bagging of the particular cheese. So that was one of the reasons. The market felt like we'd have the capacity in play earlier. Really, it's taken about a month longer, but Hilmar has figured it out. They are planning on being 75% full by Q4 of this year. So they will be back. And I think the other part too is the cash and carry trade. So if you're unfamiliar with the cash and carry trade, all it really is a player that has cold storage capacity. They can go to the CME spot market and they can purchase CME blocks and stick it in their coolers. At the same time, they're going to go out and they're going to sell futures contracts against that in their CME account, right? And as we come towards expiration of a particular contract, those prices need to converge and become one. And so it's a little bit of an arbitrage opportunity where they're guaranteed to make money. And so when we were down here, they were buying block cheese at about $1.65, $1.70. They were reaching out into their CME accounts and they were selling cash settled cheese futures at $1.95, right? So they had 25 cents of profit potential. 2 weeks ago, the price came together and they both met at $1.95. As a result of that, those previous buyers came back to the market and they became sellers, offering the market that cheese that was in their inventory to end users, opening up their space that they could use again. Today, we find that September futures are at $1.95 and spot markets are at $1.78. So what do we think is going to happen? They're going to enter into that same exact trade, which likely means that cheese prices have limited downside from where they're currently at today. Okay? So they're going to enter back into that structure. We've also seen a ton of volume moving. So just in the last 3 months, we have seen some of the top volume of CME spot blocks and barrels across the last 5 years. So 3 of the top 14 have happened in the 3 of the top 14 months have happened across the last 5 years. When we look at cheese exports, we're running well ahead of pace. So year to date, we're at 420 million pounds with the April edition of the export report, and we're 25% ahead of the 5-year average. Keep in mind that last year we exported 1.125 billion pounds of cheese, and that was an all-time record. And we're already outpacing it by 9% this year. And with the current makeup of US versus Europe, that should continue. We should actually blow the doors off of that. We've heard of exports into Q3 already, and so we expect this trend to continue. The other cheese relationship that we do watch is the European Union mozzarella price versus cheddar barrels. And the reason for that is these new modern cheese plants do produce more than one variety of cheese. Okay, so we have a plant in Idaho and also in California. They split their time between making mozzarella cheese and cheddar barrels. The barrels go to the fast food market. The mozzarella goes into the export channels. Today we find ourselves with a $2.20 European Union mozzarella price and about a $1.80, $1.75 after the last 2 days barrel price. We should find mozzarella exports and keep those particular facilities full with making mozzarella and exporting it off the California shore. Cheese stocks. Early in the year, I know our company was very worried about cheese stocks, and we were concerned about being an island of supply due to all of the new plants that were coming on board. The ramp-up time has been slower, and As a result of that, we've actually got our cheese stocks just north of 1.4. So we're behind the last 5 years, behind the 5-year average. We actually feel like we're in a pretty good spot. We're expecting June cold storage numbers to come in right about 1.4 billion. Should be down about 1% year over year, in a spot that gives us maybe some upward price movement, but we're not running out of cheese anytime soon, is kind of the gist of it too. Butter stocks. This is another one that we were worried about because of all of the excess butter fat coming off of the dairy farm. Today we find ourselves at 337 million pounds of butter. We were considering that we were thinking that this particular commodity could be as much as 400 million, or at least rival the 2021 highs, but that has not been the case so far. And part of the reason why we thought was, like I just mentioned, fat tests were higher, cream multiples were lower. So a lot of times cream multiples determine basically how much butter churns and ice cream manufacturers are willing to pay up for truckloads of cream to make it into their product. When we look at kind of this February, March timeframe, I just mentioned that March was a 437 butter fat percentage. Cream multiples fell down into the 75, 85 cent zone, meaning that cream was very, very easy to get your hands on. You were making butter for about $2.20. Recently, we have rebounded as summer weather's kicked in. Cream multiples are back to about $1.25 or so on that index. And I think this is very telling of what kind of happened. So stocks through March were up 109 million pounds and 15 million pounds ahead of the 5-year average. As of May, we're actually 2 million pounds of butter below the 5-year average. So what has happened? The answer again is exports. Okay? Europe at present is at about $3.80 a pound. Meanwhile, the United States is at $2.55 a pound. And there are some taste preferences that are different. In Europe, they prefer an 82% butterfat content butter, whereas in the United States, we're more or less 80%. But when you get prices as wide as $1.35, $1.40, there's value, and they'll make some changes, and they'll go after that opportunity. There's no rule of thumb that exactly says where butter is going to start to see exports, but just kind of looking at it over the years, we've noticed that it's usually around $1 spread between Europe and the United States that will start to capture those exports. And it hasn't just been butter exports. We've also gotten 8.2 million pounds of anhydrous milk fat off of our shores. So butter exports have definitely kept our inventories in check as a result of that. Powder, on the other hand, we saw some pretty tremendous exports in February, March, and April. A lot of that had to do with price action that really fell off a cliff. We were trading up towards $1.35, $1.40. When we got to February, even January, what was the storyline? Trump came out with the initial tariffs, right? And powder prices really started to fall. We booked a lot of powder exports in this territory, and as a result of that, we've come back up to the world market. Now, we're not necessarily exporting a ton of powder into any particular region other than Mexico as it sits today, mainly because of the proximity between the United States and Mexico. But Mexico is the #1 buyer of U.S. powder, and the U.S. is the #1 provider to Mexico. Last year in 2024, Mexico essentially bought all of their powder from the United States. So Mexico continues to be a very, very important trading partner with the United States. The other piece that also took effect in late January and really across Q1 is the U.S. dollar became a lot weaker. As we put forth a lot of the tariffs, the U.S. dollar did fall from a high of about 107 on its index here down into about 97. That has created a lot more purchasing power for foreign nations to get their hands on our commodities. You look at Japan. Japan is up about 11% year to date against the U.S. dollar. South Korea buys a lot of cheese from us. They're up about 8% year to date against the US dollar. And the Mexican peso is also up 5% year to date against the US dollar. So that alone has made our products a lot cheaper buy for our foreign players. Switching gears to the consumer a little bit, we always watch the University of Michigan Consumer Sentiment Index, and it's not good, right? So we're down at about 50 on the index. That's very close to the lowest reading that we've ever had in that particular index. So that tells us that consumers are not feeling all that bullish about the future. Inflation's also up. So when we look at inflation, consumer expectations 1 year from now is up 7.3%. That's the highest registered level since April of 1981. So consumers are thinking that inflation is going to continue along and not drop off. Margins are getting better, however. Margins, according to the personal savings rate, we're up 0.8% month over month and 5.5% year over year. The personal savings rate is also up. It was up 4.9%. So the difference between personal income and expenses was up about 5%. That's the highest that we've seen in 11 months. And then gasoline prices year to date are down 12%. Now, that's not going to last, the gasoline part, because we did just see last week Israel lob some bombs at Iran. And as a result, CME crude, CME diesel, CME gasoline prices are already up 20 cents a gallon. As a result of that, that's going to hit the consumer at some point. It has not yet. But we have, through at least the first 5 months, seen some improvement there. Retail sales are also growing. So sales were up about 3%. This is kind of an indication that we're seeing more and more consumers going to the grocery store. We do still have inflation hitting the grocery stores, but domestic demand overall is down. So this takes into account grocery stores, this takes into account sit-down restaurants, takes into account fast food, so on and so forth. And at present, we're actually in negative territory compared to a year ago. So domestic demand is still very much so a question mark. That's why we are concerned if we lose the export market for cheese. How in the heck can our domestic usage keep up to all the new processing? We're seeing a little bit of shifting behavior. So on the chart on the left, that's the big pizza stores. So you have Papa John's, Pizza Hut, and Domino's. Right now, their menu inflation is up about 4% compared to last year. And when you look at Pizza Hut, they're in the green. They haven't had a profitable quarter in 6 quarters. Papa John's has not had a profitable quarter in 5 quarters. And Domino's has performed the best, but they're also sneaking into negative territory. The other piece is the GLP-1 medications that are becoming a hot commodity, as well as Ozempic. So those particular drugs are aimed at reducing weight, and 6 months after jumping on GLP-1 regimens, according to Cornell University, consumers are spending 6% less at grocery stores and 4% less at restaurants. So as that continues to grow, that's going to affect some of our domestic usage and potentially foreign as well. Cheese, butter, and ice cream don't seem to be winners in the GLP-1 piece and research. The stock market. So the stock market's kind of been all over the place. It's tracked very, very closely with tariffs. Coming into the year, the S&P 500 was up around the highs. Tariffs came out along with the US dollar and multiple other things. The stock market fell back pretty aggressively. Since then, and since we started to curb some of our tariff discussions and put them on pause, the stock market has again rebounded and essentially come back right to where we went to. So we watch the stock market very, very closely, obviously, because whenever finances are a little bit stronger in the retirement or the stock accounts, generally you do see a little bit more aggressive purchasing. Slide ago or two, we saw weaker demand kind of fall off. That was during this period right here. Stock markets offered a little bit more uncertainty in stock accounts and 401ks. As a result of that, consumers reduced some of their purchases that they were seeing. The fact of the matter is, when consumers are more confident in those accounts, they tend to spend a little bit more money. The housing market. So the housing market has been a piece that has offered tremendous homeowner equity that consumers have been able to utilize. We've seen basically a lot of buyers right after the COVID period through 2023, and they really chased prices up. Homeowner equity was up $677 billion, up 78%. And we're starting to see a little bit of a crack in this armor. We're starting to find that we're seeing a few more sellers than buyers. And according to Redfin, in April, they expected that there was 500,000 more sellers of homes than buyers of homes. And so we do expect to see maybe a little bit of a shift in this particular case. The cities are likely going to see the biggest downfall of that. Tampa, Phoenix, and Dallas are leading the pack. I know just kind of in our rural area, I know a couple of cousins have kind of moved recently, and their houses haven't necessarily brought quite as much as what we would have expected originally. And so I think you are starting to see a little bit of a shift in the housing market as well. So we'll watch that. And then we're seeing an increase in buy now, pay later programs. So Aldi is in Platteville. That's typically where I get my groceries from. I know every time I check out, there is the offering. Do you want to pay for it now? Do you want to pay for it later? Do you want to do installment plans? Yada, yada, yada. Across this program, 25% of respondents are saying that they're using buy now, pay later programs for groceries. I guess, to me, I find that as a rather large concern. Currently, debt in buy now, pay later is $300 to $350 billion. Compared to credit card debt, which is currently at $1.2 trillion, it's a little bit modest. And credit card debt is down about $2 trillion, or not $2 trillion, but $200 billion, I suppose. It was at $1.4 trillion previously. I think that's something that we need to watch moving forward. So percentage of buy now, pay later, paying late. 41% of people say that they have had a missed payment under this particular program. I can't tell what that number is, but whatever that number is, they said that they've had a late payment on the buy now, pay later, but not in the past year. 45% have not had a late payment using the buy now, pay later. So that's a relatively new payment method, but one that is kind of concerning to me. Now, what should we expect for Class 3 prices in this coming year? So let's look at some statistics. Over the past 10 years, 50% of the years have had a price north of $19. When you look back at January, we were at $20.50. February, we were $20.25. March was just underneath that at about $18.40. April was $17.45. May is going to be about $18.70. June is also going to be a pretty solid month. So arguably, the first 6 months of 2025 almost cleared $19 other than one or two of them. 90% of the years we had a minimum below $16. The lowest we've gotten so far is $17.45. We have not gotten to a price where we are going to curb milk production. The economics have not gotten tough enough on dairy farmers. They're going to continue to grow the herd as a result. We have seen a lot of volatility. We also tend to spend a lot of time in unprofitable territory. So in our opinion, it's very, very difficult to imagine that at some point during 2025, we are not going to try to test $16. It's our belief that it's going to happen in Q4 of this year. The reason for that, the more time that goes by, the more time that those cheese plants can get built and bring in the milk. And after the holiday purchasing period, which happens in August, September, October, we don't have a ton of demand that really plays out in the November and December markets. So we expect Q4 to be relatively soft when it comes to settlement time. Prior to that, as we build up in July, August, we could have shortages of milk and things of that nature that kind of prop it higher. But we are in the camp of making sure that we have Q4 well hedged as well as Q1 2026. So these are the current DRP opportunities that are out there for Class 3 and Class 4. Q4, we're currently looking at about $18 on your minimum for 32 cents. Q1 2026, we're at $17.34 for 37. Class 4 side, we're looking at $18.93 for 26 and Q1 $18.77 for 36. We don't see any reason to wait around on the Class 4 side of the equation. While we think butter has some upside, those are profitable levels for dairies, and we would say take the risk off. Class 3, you can probably wait around a little bit longer. The opportunities aren't quite as great, but any type of rally I'd probably be jumping on. Don't forget about LGM Dairy. So there's been huge changes to the LGM Dairy program across the last 3 years. Okay, they're trying to get LGM Dairy to be a very competitive tool with DRP, and they have made the biggest change is moving from a monthly offering to a weekly offering. That happened 2 years ago. And then last year they moved from an average price for Class 3 milk, corn, and soybean meal on Tuesday, Wednesday, Thursday into just a Thursday derived price. We are seeing this program get utilized more and more. Farms are growing. There's no more volume limitations. It used to be 24 million pounds for the year and you were done. You can put as much milk into this program as you want. The best part about LGM Dairy is that you can get a 1 or 2 month coverage pack. So a lot of times you are putting 100 weight in a particular month and then you're loading up on the second month. That gets you the subsidy. That gets you a CME put option look-alike. So we're doing a lot more of this program ourselves, specifically for dairies in Wisconsin, Minnesota, South Dakota, Idaho, or any particular operation that has more than one site. Then you put one under Class 4 DRP on one site and one under LGM Dairy. Now, if this particular program goes to a daily offering, we will be using this basically throughout the upper Midwest that has a large percentage to Class 3. We've already sponsored a bill to the RMA with producer signatures on it to turn it from a weekly offering to a daily offering. So that's something that we are pushing very aggressively for our dairies in Wisconsin, Minnesota, South Dakota specifically. Farm finances. So we look at the DMC program as kind of a barometer as to what and how things are doing on the dairy farm. Right now, DMC would say that the margin is $12 income over feed. It does not take into account labor or any type of inflationary type expenses, so it's probably not quite that number. That is the all milk price, corn, soybean meal, and also alfalfa in that formula. And then also beef finances. This is the June 2025 live cattle. We are up towards $2.30 a pound or $230 a hundredweight. That's an all-time record price, and we're hearing reports from our dairymen saying that between cull cows and beef on dairy, you're adding at least $3 a hundredweight to the profitability. And when I mentioned that to a dairy last week, they kind of laughed and said it's closer to $4. So I would say it's probably closer to $3.54. And this is really starting to alter the way that dairies think about milking cows. They're making decisions based upon beef primary and milk secondary with the beef on dairy animals that we are getting. So that's kind of wild. Now, do fewer animals mean higher prices? If you look back at history across the last 5 decades, you'd actually say no, right? So we've seen cattle markets kind of in some poorer territory despite the cattle herd going down. But in 2021, 2022, we saw a massive drought in the southern states as well as the western states, which sent a lot of mama beef cows to the slaughter and a bunch of heifers into the feed yards. And so we've been trying to recover ever since then. We essentially started building after 2014. Currently, the cattle industry, the beef, is at 86 million head. That's the lowest since 1951. And when we look at the beef cow herd, we're at 27.9 and the lowest since 1961. So in this case, lower animals have indeed meant higher prices, even though that hasn't always been the case. Now, this is one of the oldest cattle cycles alive, or oldest cycles, not just cattle. Anything that ends in 6 is generally a bad year for beef cattle and beef cattle prices. You go all the way back to 1976, that was the low. 1986, it wasn't the low, but it was right there. 1996, it was the low. 2006, it wasn't quite the low, but it was right there. And if it hadn't been for essentially COVID, this would have been the low as well. So I'm not saying that we're necessarily going to see that, but you will find traders that follow this trend next year. Okay, so you will see a bunch of people get short puts. You'll see some people get short futures to see if this trend will play out. It's up in the air. Now, I will say we have found different price ranges basically every single decade, right? So the question is, will this be the new kind of decade norm, that particular territory? We'll find out. Beef values, however, are rising. So recently we saw the beef cutout trade above the 2023 highs, that green spot right there, that high. We've seen wholesale beef prices increase 17% year over year. Retail prices are up 14%. Consumers are paying $5.81. That's as of April for ground beef. So that's up 11% year over year. In contrast, cattle prices are up 27%. And so the packers are buying high value cattle from cattlemen over here at a greater pace than what they can sell it to the grocery stores and the end user over here. That means they are losing money. The packers are only going to lose money for so long. They have some tools in their toolbox to address that. At present, packer margins, they're at that negative $153 a head. Across all the kills in America, that equates to over $100 million a week that they're losing. Now, it's hard to feel bad for them because when we look at their margins over here, between 2018 and 2023, they didn't have to do much, and they were printing money. And when you look at COVID, they were making astronomical amounts of cash off of cattle. But they have dipped down into this territory. We are looking at them being in their third losing quarter in a row. Typically, they'll let it go about 6 quarters, and then they start to change things. And the biggest piece that they'll do is they will close capacity, right? So back in 2014 through 2016, 12% of the beef capacity closed down. And what did prices do after that? They absolutely tanked. We packed additional beef pounds on the carcasses, backed up the supply chain, and that's what ultimately brought prices down. They are going to do that at some point. If you look back 3 weeks, actually, there was a rumor that went around the market that said that USDA confirmed that a beef packing plant was going to get closed down. Across 2 days, we lost $12 a hundredweight out of the live cattle futures on the board. 2 days later, the USDA came out and said that is entirely false, and we've come back up to record highs. So just look at what it did to the price on a rumor, let alone what would happen if they actually do it. And they will do it at some point. Just speaking briefly on the grain markets, I see a speaker does have some grain slides, so I won't get too far into it. We're seeing big acreage. Third largest corn acreage is expected, 95 million. We'll get that report on June 30th in a couple of weeks. Soybeans had the 7th largest crop planted at 83.5 million. The crop primarily got in the ground early. We had a dry spring. We are having some issues in the eastern corn belt due to moisture. Ohio, Indiana, Kentucky, Tennessee, down to Arkansas is all wet. From a dairy perspective, New York is having a very difficult time getting their corn in the ground. So with the additional cows going there, that'll be an interesting dynamic to see to the dairy industry. But so far, conditions are okay. They're maybe not up towards the 5-year average, but I do know that the latest chart that came out yesterday did kind of increase the conditions on corn. We do have large global supplies of specifically soybeans. We have the largest supply there. That's part of the reason why we saw fewer acres. Corn supplies on hand are a little bit less than the last 5 years, and so we don't have as much of a buffer necessarily in the corn market. And we'll be watching kind of the summer weather. I know back home we got a nice shower yesterday, but the western corn belt is certainly dry. The analysts out there do not suggest that we're going to see a very wet summer, but they're also not expecting a very extreme drought either. So I think we're going to probably be okay this year. And from a dairy producer perspective, we're telling guys to respect the trend. The trend for corn is that we spend a lot of time between $3 and $4.50 per bushel. That's kind of where we're at here today. With big acres, we would say we expect that corn prices will likely drop. So use some call options to defend against upward potential in the event that we do get the drop. And we would tell guys looking at protein, just go in and lock it in. We're at $290 a ton right now. We did see some news that came out regarding the renewable fuel standard recently. That's increased soybean oil, so the crush isn't as reliant on soybean meal anymore. That dropped about $10 in the last 2 days alone. So go out and just get the meal booked into Q1 2026. We do have to talk a little bit about politics because we have ultimately seen them kind of play with the market. April 2nd, we did levy a bunch of tariffs against the entire world. April 9th, we took them off. Trump's big bet is that they need us more than we need them. So we'll see how that plays. But across different announcements throughout the year, we have put tariffs on, we have paused tariffs. We have seen the courts get into the action and say that we cannot use tariffs. We've seen 2 courts come in and say tariffs are allowed. But what's kind of sneaking up on us? We paused tariffs on April 9th. July 9th is when they potentially get restarted. And so should we go into that, history should be a good barometer. January 30th, they started. We tanked the dairy markets. In April, they restarted. We tanked the dairy markets. If they get restarted, milk's going down. Products are going down. Now, we have had a little bit of a roundabout, right? So despite us having tariffs against a lot of the world, we've essentially just changed the flag on the ship to send it to a new location. So whey markets, for example, we send China a decent amount of whey. We have not been sending China whey recently. We've been sending it into Europe instead, and the Middle East, North Africa. And Europe's been sending China the whey. So it is hurting the U.S. slightly, but we're still getting the exports in a more roundabout fashion. We are seeing it happen in China, though, on the beef front. Back in March, China announced that it was not going to renew the U.S. beef certifications. And so our beef exports to China went to 0. Meanwhile, South Korea basically offset all of it, right? So we're just kind of sending it to a new location and shifting it around. So we're going to talk just real briefly on some of the changes to the Federal Milk Marketing Order. Those are in effect right now, and that's kind of where I'm going to kind of leave you. Dairy is not necessarily as easy as corn. Corn is futures price plus or minus basis determines what your price is. It's very easy. Dairy, on the other side, takes all of these into account. So when we price out a particular class 3 milk price, we'll use for an example, we first go through the settlement process of a 4-week pricing window on the spot market. So block cheese trades on Monday, Tuesday, Wednesday, Thursday, Friday. You take the average price of that, you put it into the formula. You do that for 4 or 5 weeks. On a 2-week lag, the USDA comes out with what we call the National Dairy Products Sales Report. And that determines how much volume got traded in the physical market and at what the price was. So that's how you get to your basis number. Then we compile a weighted average across those 4 to 5 weeks using spot and NDPSR to determine what a component price is, our protein, our fat, or other solids. That determines what the class 3 price is, the class 4 settlement price is, and that's what the futures markets essentially trade off of. So dairy, it's a little bit more difficult, and then we also do our blend price. Our uniform blend, 90% to the class 3, 10% class 4, whatever that blend is, plus or minus PPD. The FMMO changes, Federal Milk Marketing Order changes, started in June of 2025. So June was the first month that we saw them. We got rid of the barrel. The reason why we got rid of the barrel is because out of all of the capacity that's made in this country, 90% of it is blocks, 10% of it is barrels, right? So anybody like a co-op that was maybe selling blocks, but they had to pay their producer on a 50-50 blend price, whenever barrels were at a premium to blocks, they were losing money, and they had to discount producers' checks as a result of that. So that's a very good change out of the class 3 formula. We increased make allowances. That's going to be a piece that causes a little bit of groaning out of the producer squad. It's going to drop milk prices about 90 cents on a class 3. And then come December, we're going to increase the component levels on both protein and also other solids. That's going to add back value to the producer check. We're going to return to the higher of class 3 and class 4 to determine class 1. That's going to reduce your PPD risk that you have with your producers. And there's a couple of other changes to yield, but we'll get into those. In the past, we were looking at 5 different cheese prices to determine. I just kind of mentioned that. You're looking at blocks, barrels. You're looking at all cheese. Today, we're looking at 2. We're just basing it off of block cheese and also our CME futures. So class 3 will be the USDA all block price adjusted to what we see in the countryside as well. Make allowances. So make allowances are basically the cost that it takes to reflect, to convert raw milk into a finished good. We used to have our make allowances on cheese at 20 cents, it's now 25 cents. Butter is 17, was 17, it's now 22. Non-fat was 16, it's now 23. So we've increased make allowances by about 5 to 7 cents. The make allowances were put into place in the 1990s. As we all know, costs on the dairy farm have gone up. Costs have also gone up in the processing world. Now, this is a very intriguing piece. So we're seeing a lot of uber efficient plants get built that are probably going to be able to produce the product for less than the make allowance, right? So that becomes a profit center for these more efficient plants, which puts risk in the smaller, inefficient, older plants that are being run. So don't be surprised if a large 8 million a pound day processing plant comes to Wisconsin or comes to Minnesota and makes it more difficult for those smaller plants to compete. So take that into account. Yield factors weren't touched other than the cheese butter fat, so we won't touch much on that, but that's basically how much butter or cheese can be made out of 1 pound of butter fat or 1 pound of protein. And this is kind of the old formula. I know I'm running out of time, so I'll just kind of move forward. These are the temporary formulas that we do have. So we updated the make allowances. Using a higher factor here is going to reduce the overall milk price. And the change that's going to come in December is this piece. We're going to add back components. So we're going to increase the protein piece to 3.3, other solids to 6%. If we look at June 2024 as an example, by just adding back components, we would have added 43 cents per hundredweight back to the class 3 formula by that change. So that is a very good change for dairymen moving forward. So that's all I have. If you're looking for maybe a device where you want to follow free quotes at a 10-minute delay, we do have an app for you. I know CME is starting to charge a little bit. Feel free to use that. You can see not only quotes, but you can also see DRP offerings and things of that nature, soon to be LGM as well.
This institution is an equal opportunity provider. For the full non-discrimination statement or combination inquiries, go to www.extension.iastate.edu/diversity/ext.